Hi. Thanks, Prem and Anita, for again inviting me for the session. So we had a very insightful session right now to know why people want to go global, why people want to invest overseas. Obviously, asset diversification is something which everyone is talking about. And there is a lot of interest that we are hearing from our clients who want to invest overseas, especially in the AI space. Because as India is evolving on AI, but the real trust lies out there. So people are finding a lot of interest to invest in overseas company. Investing overseas is not an easy matter for Indians. It's a very controlled sector. Obviously, RBI monitors it very closely. I will talk about a few instances where, they have kind of controlled it or stopped certain events as well from happening because they don't want an easy flow of money outside India. Having said that, obviously, they have well controlled, well managed it, given people avenues, but keeping a check and balance on how much you invest overseas, where are you investing, what are the mechanisms of how you bring the money back, and what is the taxation on it. So just deep diving into it. I have tried to simplify the presentation. To start with, we have basically 4 options of investing overseas. The first one being the LRS route, which everyone knows about, called the Limited Liberalized Remittance Scheme, where you are basically allowed as an individual to invest overseas. There were certain ups and downs on the limits that was allowed to be invested overseas. As of today, any individual can invest up to USD $250,000 per annum overseas in specified instruments. Apart from this, you have an ODI route, which is basically overseas direct investment route. The intent of this route is more to do capex kind of investments, long-term strategy investments, where you're intending to invest in overseas businesses rather than making a portfolio investment. There are again certain aspects on the route which we'll touch upon. The third one is the OPI route. This is something which has recently opened up when the outbound regulations got amended sometime in November 23, where they basically kind of gave you an avenue that if you wanted to do a portfolio investment, apart from the LRS route, this could be used. And the good part about this route is that it is not limited to only individuals investing. This route is allowed for even Indian entities to invest. So today, if you have like a family office which is formed, could also use this route to make portfolio investments overseas. Last but not the least is the fund route, which we again touched upon sometime back. We heard about it. You had the Indian mutual fund routes where you could invest in mutual funds. They are investing overseas. So indirectly, you have an exposure to overseas investments. You have the Indian AIFs, which were also allowed to invest overseas. But both these routes, the limits have been exhausted. And there is no likelihood that these limits are going to be opened. But having said that, we have the gift funds, which are coming up right now, where you're basically allowed to invest in gift funds and which are far more liberalized now. And these funds can easily invest overseas. In fact, the instruments where the gift funds can invest are more simple and more large based or, diversified compared to if you were investing directly in overseas market. So coming to the first one, which we touched upon, the LRS route, as I said, this is allowed up to $250,000 per annum. It allows you to invest in any type of equity instruments or debt instruments. I don't know if any of you all have heard the concept of safe notes. This is a concept which most of the US companies follow, where they intend to say is that you're basically giving a kind of a debt instrument to a foreign company, which can convert into securities in the future. Now, that kind of an instrument today is not allowed by Indians to invest into. What India allows overseas investment is into equity, CCD, CCPS, something which is value measurable. For instance, you can assign a value to it. Since safe notes convert into a future value, we have received some kind of queries from our clients that how do I invest in such cyber securities. So this is not allowed under the LRS route. And this route is the only route per se today which allows you to invest directly into immovable property. So holding real estate assets is allowed only through this route. Apart from this, your current account transactions, your travel, medical, education, etc., all can be factored out here. You are not allowed to invest directly as a resident into a financial services entity outside India.
Much invested at Citibank.
Citibank stocks, because it's listed portfolio investments, that is allowed. But if you are looking to invest into a fund manager entity or into an investment company, you cannot invest under the resident, like as an individual. Even it is listed is allowed. That's a portfolio investment. But if you're looking for an unlisted entity, there it won't be allowed. The money that you are holding abroad has to be brought back to India within 180 days unless it is further redeployed. So there So there are certain restrictions upon how long that you can hold the money outside India under the LRS route. From a tax perspective, there is a TCS applicable at the rate of 20% on any remittance that you do under the LRS route exceeding INR 10 lakhs. The TCS that you pay is creditable. In between, when there was a lot of, these offshore funds, gift city funds were being set up, people were deploying money not only from their accounts, but even from the miners' accounts, which was being subject to TCS. So we have received queries that how do you get a credit for the TCS that you pay on your child's name in the name of the major. So this amendment was done a year back in the tax laws, which allowed you to even get the credit for that. So basically, you can diversify your portfolio by investing not only in the name of the major, but of parents, but also you can use the accounts for your minors, and this credit is available. But yes, this is a tax leakage which one needs to factor. According to me, it's major only, which is allowed because ultimately minor does not have its own separate source of income. Coming to the tax rates is basically, it's all standardized now. Earlier, we used to have multiple tax rates of 20% and 10% and all, which has been changed 2 years back. Now, whether you're holding an Indian security or a foreign security, the long-term capital gains tax rate has been standardized to 12.5%. Also, the holding period out here has become 2 years, again sacrosanct. There is no indexation benefit. So this was an arbitrage which was happening because indexation was available for Indian securities. It was not available for foreign securities. Once this has gone, now everything is coming on par. The short-term capital gains would be taxable as per the applicable tax rates applicable to the individual. Obviously, when you're investing overseas, there could be local taxes that you have to pay in the overseas country. You will get a credit for those taxes in India, but you need to complete certain formalities, report it correctly in your tax returns to be able to claim the credit for these taxes. One thing that one should also be mindful of, that in case there is a treaty which provides for a lower tax rate for those type of income, then are you able to claim a credit of something over and above? So for instance, like in US, the interest income is subject to tax at 30%, but under the treaty, it's subject to tax at 25%. Now, if the US company won't really bother because it's such a diversified, they won't go and test the treaty for one individual investor. They may just withhold at 30%. But you would be able to claim credit for taxes in India only at 25%. So that could be a leakage. So something that you should be mindful of when you are looking at the structure. So this is not really too much for, individuals who are looking to do portfolio investments. This is more from the perspective of people who are looking to set up presence overseas and they want to, get into a fund management business or kind of get into an operating business. But one thing that I want to touch upon out here is that what people were talking about is that, say, you have a lot of family offices today who want to invest overseas. They want to set up an investment holding company overseas instead of every time remitting money from India. So you just set up a company, say in Singapore or Mauritius or Cayman Islands, and that entity becomes your holding company for your overseas investment. Now, that kind of an activity, whether that is a permissible activity, is a big question mark. Because today, when you are investing from India overseas, you are investing under the ODI route. The ODI route is allowed to be investing only in the bona fide business activity, whether investments by itself is a bona fide business activity is a big question mark. And to the best of my knowledge and to the way we have been discussing with most of the AD bankers, it will not be an advisable route to follow, where you just form a holding company overseas to hold all your investments. So therefore, we need to find this route typically will be used only where you are looking to invest into operating companies or it's more of a strategic investment. Yep.
Like when you put ODA company at this time, for the will be like you let the teacher the property. So that you take the section now.
Yeah, there it is. So this you're talking about is ODI in financial services sector. So those conditions yet continue to be there. They have kind of liberalized those conditions. If you are a non-financial service sector entity in India, you just need to have 3-year profit track record, and the 3-year profit track record condition is not applicable if you are investing through Gift City. But again, this would be not so relevant again for individuals who are looking for portfolio investments. In case some family office is looking to set up a overseas, like, a full-blown portfolio for making overseas investments or targeted investments, then we need to dwell into this more and understand which sector or which structure would work the best for them. Coming to the next one, this is the most interesting one and the one which is the most opened up sector, which allows far more investments, and it is something which very well blends with GIFT City. So this is basically OPI. Till now, as I was discussing, LRS route allows you to only individuals to invest overseas. We obviously have a lot of family offices which are pooling money. They have set up an NBFC, they have set up a family trust, or they are forming LLPs to invest overseas. So that is basically pooling of their capital. The OPI route basically allows any Indian entity to invest up to 50% of its net worth, in specified securities overseas. So today, if you have a family office which is formed as an LLP, they can, under this route, invest up to 50% of their wealth overseas. And there are obviously certain conditions out here, like an unlisted Indian entity cannot access this route for investing in an overseas market. But if this unlisted entity goes through GIFT City, then this route is allowed. Now, obviously, going through GIFT City is not so easy. You cannot set up your own vehicle out there, that we will touch upon. And so basically, we have players like Marcellus, we have Equitas, most of the Indian fund houses who are basically setting up outbound funds. When they are raising money, they are raising money from non-resident or from resident individuals, as well as they want people to access this OPI route because their family offices can easily invest up to 50% of their net worth. So the $250,000 would not be a limitation for them. They can allocate much more wealth of theirs through this route for investing overseas. So there are two types of basically structures. One is the unlisted entity, which I just discussed about, that you cannot directly have an unlisted entity investing overseas directly, but you can have the structure very well through a GIFT City structure. The second one is listed Indian entities or individuals. So today, as an individual, I can invest directly in a BlackRock fund overseas, because the BlackRock fund, as long as it's a regulated fund, I can invest under the OPI route. So therefore, my ability to invest a higher amount compared to an LRS route is available to me today. But the condition out there is that this should be a regulated fund. It should be registered basically with a regulator out there, or their manager should be regulated by the home country. So most of these people have a separate GP entity which is regulated by SEC and all, and therefore your direct investments in such funds are allowed. From a tax perspective, honestly, the taxation now remains the same, whether you are coming under the LRS route, or you're coming under the ODI route, or you're coming under the OPI route, because they have standardized the tax rates. This will all differ when you are coming through a fund vehicle structure. So just to touch upon now what is available basically in IFSC, these are very important stuff. As I said, funds set up in IFSC, they are allowed, you are as an individual or as an OPI are allowed to invest under automatic route 100% of your, or up to the limits that are set up under the particular routes into each of those companies. These are deemed OPIs. The reporting and conditions and all are very simplified out here. Obviously, the KYC, onboarding, etc. could be there, but these are not so stringent. The regulatory caps, what I meant is that from an IFSC perspective, there are no regulatory caps, but from an OPI route perspective or an LRS perspective, you need to adhere to this. The taxation out here is quite a little bit on the complex side. So just to touch upon that, if you have a fund in GIFT City, which is investing in overseas securities directly, and most likely these would be open-ended funds, so I would not complicate it with the category 2 AIFs and all. But these would be funds which would be basically directly investing in overseas securities and churning the money. Now, the taxation in these cases would happen at the fund level, and the fund is paying taxes. So most likely, it's not deferment of taxes, right? Your money that you have invested in the fund is getting churned, and at every churn, the fund is paying taxes, and hence the amount available for deployment reduces with them. As against this, if you had invested in an overseas fund, obviously no tax in India arises unless you redeem the securities. So to that extent, there was a lot of representations done to the tax authorities that this regime for outbound funds should be simplified. Either it should be aligned to a mutual fund, or it should be aligned to an overseas fund, that when they are churning, no tax should be applicable, and it should be applicable only once I redeem my money from the fund. But that is unlikely to happen, and as it has not happened in the last 3 to 4 years. So from a taxation perspective, what you will see is that whenever the fund will churn money, the taxation will happen. When you redeem the money, there is a view that obviously it's a one-level taxation, and hence on redemption, further no taxes should be applicable. There have been structures in the past, or if you have situations where your GIFT City fund invests in another overseas fund. So it is more like the GIFT City fund is a passive fund. Say it is invested in another BlackRock or a Schroders or a Marcellus fund somewhere outside India. Or they have a two-tier structure. All the churning is happening one level above the GIFT City fund. So no churning is happening at your GIFT City fund level. So in that situation, no taxes are paid in India. It's only when a request for redemption is made in India that the GIFT City fund would redeem something, and that is the point in time that they would land up paying taxes. So we have seen quite a few structures coming up on those sites. Instead of creating a one-tier structure, you create a two-tier structure. But there are certain balances that you need to maintain from a GIFT City standpoint on this matter, because they would not prefer someone just creating a two-tier structure for basically deferring taxation. So there has to be an intent that you're raising a global fund, etc. out there. I don't know if you've heard about this global access provider. So basically, GAP is a new product that GIFT City has started, where you're allowed to create an offshore wallet. So there are a lot of players who are taking a GAP license. The intent is that these people can hold money of an Indian resident or a foreign resident, which you can use for any of your overseas transactions. So, like a simple example, if today someone does not have an opportunity to do an LRS, you have used only $100,000, but you obviously want to use your limits every year to hold money abroad. Why do you want to waste upon the balance $150,000? You could actually park it in the GAP account, and your money has now sitting in a foreign currency. Your any transaction of investing overseas, education, current account transaction, medical, etc., everything can be sourced from here. So instead of having the FX hit every time or being bothered about it, this is something very new which has opened up and which is being promoted a lot today by IFSCA. Other is a broker-dealer license, nothing so relevant from the perspective of investing, as an additional avenue. But today, for instance, if I wanted to buy an Apple stock, I would write to an Indian broker. He would tie up with a non-resident broker and he would do the investment. Now, all this is actually not controlled by SEBI. My stock is sitting with an offshore broker in his bank or in his books. It's not that directly it's sitting or it's regulated by SEBI. People are aware about this industry, but as such, it's not regulated. What IFSCA has done is they have come with the concept of a sub-broker license in IFSCA. So today, you have Ind Money, Alpaca, etc., who are basically taking this sub-broking license. You can tie up with them. And now you're officially or in a regulated manner. Through them, you can do overseas investments in the offshore stocks. So as an investor, you are feeling more secure that there is a regulator who is overseeing your entire investment activity. Third-party platforms is another product. Again, this is not really so if there is someone, we have come across cases where there are individuals, or before this, I would like to actually touch upon family investment funds. I don't know if you guys have heard about this. So when the IFSCA came out with the regulations on fund management industry, they had a product called family investment funds. So generally, if you set up a fund requires a fund manager, a fund which does pooling of money. They came out with this concept of FIFs, which allowed Indian family offices to set up a single investment vehicle in GIFT City. And this vehicle in GIFT City was even allowed to some extent invest in real estate assets. And when the regulations came out, all the family offices went after it. Everyone just applied left and right, obviously, for this registration, because it was a very open-ended regime which allowed you to easily take money abroad. You didn't have any requirement of forming a fund manager. You could manage your own money, etc. out there. But obviously, this was something that RBI feared, because now everyone would set up an FIF. There were no limits required out there. And once money went outside India, you didn't have any control on it, on how to get it back. So while IFSCA has been approving the registrations, RBI through the AD bankers stopped any remittance to be allowed for FIFs. So that's where I was saying that this becomes a very regulated sector. You have RBI, which is controlling every aspect of this thing. So FIFs are now not prevalent in the market, or there was one which is approved, but it is not operational. There could be an alternate to that, is a third-party fund platform. So third-party fund manager platform is something like basically you could tie up with fund managers out there who could, on your behalf, make investments overseas. Only thing that one needs to be mindful out here is that you have to have pooling. So if you have a group of individuals who are aligned on their investment strategies, they could use such service providers in GIFT City and be able to invest overseas. Obviously, the investment would yet happen either under the LRS route or the OPI route. But again, it's not like you need to be a very diversified person who's putting into a completely third-party fund manager. You could, through this structure, control the money and decide where you really want to invest. So net, basically IFSC has given a lot of options today to investors to take money abroad. What was the old structures, which was mutual funds, AIF, they are majorly dying down because of the limits being exhausted. And at the same time, IFSC is making it more and more liberal and easy for people to basically invest overseas. We have a lot of mutual fund houses which are promoting a lot of outbound funds. We have the ticket size which are being reduced under the retail FME license. So, yeah, so this is the key thing.
Mark to market basis, the taxations are available, taxations are applied.
Where? In US?
In US. Whether it is realized or not realized, on a mark to market basis, the taxation happens.
Okay.
In USA, that is one thing. Second is, suppose somebody is going there after exhausting his $2.5 lakh limit and he uses their Forex card. Whether that will be added to LRS and then I am violating the rules. Sorry, thank you.
Sorry. So first one, yes, maybe US is levying taxes on the fair value because that's the way the regime out there works. But the credit for those taxes will be available to you. So, in the sense, ultimately, I understand your point that it is a fair value gain. If tomorrow it underperforms, you don't get a capital loss kind of a thing out there. So it is, but eventually when you'll redeem, the taxation in India will arise only on redemption. And at that point in time, you will have to maintain a record of all the taxes that you have paid on that over the years in US. They typically, they generally do issue a K1 or something. In those forms, the taxes are mentioned and you can use that as a basis for claiming the credit in India. But that cannot be avoided because that's a local law. And as regards reinvesting that money, so yes, you can. So if you have invested under LRS route abroad, if you have earned further money on that, you can easily deploy that money. It's not subject to the $250,000. If you don't deploy it within 180 days, you have to bring it back to India. Once you bring it back to India and you take it back, then it will be subject to LRS limit. But generally, people will park it like in an FD. Don't do anything. Even if you don't find an opportunity, just park in an FD. Or